Most people think they're building wealth. They're not. They're building the appearance of wealth. And there's a very specific reason the two look identical from the outside. Here's what nobody tells you. Robert Kiyosaki's definition of assets and liabilities, the one that made Rich Dad Poor Dad sell millions of copies, is technically wrong by accounting standards, but it's psychologically the most accurate thing ever written about money. And most people still miss the point, because they read the book, nodded, felt smart, and then went home and financed a car. The problem isn't that people don't know the difference between assets and liabilities. The problem is that our brains are wired to feel like liabilities are assets. That's not a personal failure. That's a design flaw, and it's being exploited. Right now, entire industries exist to blur that line, on purpose. And by the end of this video, you'll see exactly how they do it, and more importantly, how to stop falling for it. Here's the reframe that changes everything. Stop asking, is this an asset or a liability? Start asking, which direction is the cash flowing, toward me or away from me? That's it. That's the whole game. An asset puts money in your pocket whether you work or not. A liability takes money out of your pocket whether you want it to or not. Simple, right? But here's where it gets uncomfortable. Your house, the thing you were told is your biggest asset, is for most people a liability. Property taxes, maintenance, insurance, mortgage interest, cash flows out. Now before you argue, yes, homes can appreciate. Yes, there are scenarios where it makes sense. But appreciation isn't income. Appreciation is a bet, and most people are betting their entire net worth on one illiquid asset they also happen to live in. That's not a portfolio. That's hope. Here's the first deeper layer. Most people have what I call a liability portfolio masquerading as a lifestyle. Car payment, subscription services, a house that costs money every month to maintain, maybe a boat, gym membership they barely use. None of these are evil, but together they create something dangerous. They create a ceiling on your freedom, because every liability you hold requires you to keep earning at a certain level just to stay in place. Your lifestyle becomes a fixed monthly obligation. The treadmill gets faster. You run harder. You look busier. You feel more successful. And your net worth barely moves. Now here's the statistic that should stop you cold. For most families, the majority of their net worth is tied up in home equity, which means their actual income-producing assets are surprisingly small. Assets that generate real spendable cash flow, often far less than people imagine. And yet these same families feel wealthy because they live in a nice home, drive nice cars, and own visible symbols of success. The feeling of wealth and the function of wealth are two completely different things. Wealth that doesn't produce income isn't wealth. It's a museum. So why do we keep collecting museum pieces? Because of something I call the visibility trap. We're social creatures. Our financial decisions are deeply influenced by what other people can see. A brokerage account is invisible. A luxury car is not. An index fund quietly compounding in the background. Nobody at the dinner table knows about it. But the new gadget, the renovation, the upgrade, everyone notices. This is why so many high-income earners are quietly broke. They've optimized for visible wealth, the things people can perceive, at the direct expense of functional wealth, the things that actually work while they sleep. And here's the contrarian take. Frugality is not the answer either. Cutting every small pleasure, living like a monk. That's just the other extreme of the same mistake. It's still letting emotion drive financial decisions. Just a different emotion. The actual answer is colder, more strategic. And it requires a framework. I call it the cash flow audit. 3 columns. You can do this tonight. Column 1, what you own. List every asset you have. Next to each one, write whether it produces income, yes or no. Column 2, what it costs you. Every liability, every monthly outflow, be brutal. Include subscriptions, insurance, interest payments, everything. Column 3, the ratio. Divide your income-producing asset income by your total monthly liabilities. If that ratio is below 1, your liabilities are outpacing your asset income. You are, by definition, dependent on your job to survive. Most people who do this audit are shocked, not because they're bad with money, but because nobody ever asked them to look at it this way. The goal isn't to eliminate all liabilities overnight. The goal is to make the ratio move every single month in the right direction. But here's the layer most financial conversations never reach. Assets and liabilities aren't just financial. Your time is an asset, but only if it compounds. A skill that makes you more valuable next year than this year. Asset, a job that pays well but teaches you nothing new. Potentially a liability. Your attention is an asset. But most people rent it out cheaply to distractions that generate nothing for them. Your network is an asset or a liability depending on whether the people around you raise or drain your trajectory. When you start mapping this framework onto life decisions, not just money, everything sharpens. Because the question is always the same. Which direction is this flowing? Here's the realization that tends to hit people late. The goal was never to be rich. The goal was to be free. And freedom has a very specific price tag. It costs exactly the amount of income your assets generate minus your liabilities. When that number crosses zero, when your assets cover your liabilities, something shifts. You don't have to take that job. You don't have to tolerate that client. Choice becomes available, and once you understand that, really understand it, you start making very different decisions. You stop buying things that manufacture options. So here's the final reframe. Stop thinking about assets and liabilities as just a finance concept. Start thinking about them as a philosophy of how you allocate your one non-renewable resource, time, and your one depletable resource, attention. Every decision you make either increases your optionality or decreases it. Every unnecessary obligation is a small vote against your future